Welcome everyone. Welcome to the class for auditing. This week we will be focusing on finance and investment cycle. Last week we did the inventory cycle, and this is the life cycle that we're going to look at. And then thereafter, I'm going to use the coming sessions for review, for catching up on the topics that we've covered, from corporate governance to these cycles. So it will be a big thing that we will be looking at. And yeah, so just be prepared, because I'm hoping that throughout these past weekend, looking at the theory that we touched and the questions that we did, it made you guys to go back and read more on the cycles and prepare your notes. So I'm hoping that the questions that we will cover during our revision will help you guys more on exam technique, because exam technique works very well when you have a proper understanding of the cycle. So meaning that you have the knowledge. It's just that now we're practicing how to answer the questions. Okay. But anyway, without wasting time, let's jump into it. Finance and investment cycle is very short and very small, but we're going to look at the questions, few activities where I'd like you guys to participate and talk, so that I can see how you guys think and approach questions. And we'll look at one exam question, and then depending on the time, that's when we can revisit one of the cycles that we've covered to start this whole revision that I'm talking about. All right. Topic outlines for today, we'll be looking at capital expenditure as to what it entails within the cycle. We will also look at the risk and internal control in the cycle, and activities as I've mentioned. And hopefully by the time that we are done with this cycle, you will be able to know what a capital expenditure is and what are the risk and internal controls within the cycle. Okay. Right. So finance and investment cycle, it is investing and financing activities. I'm sure if some of you guys are doing accounting, you would have seen it as part of your cash flow. On your cash flow line items, there is an investing and financing activity line item. So what does it mean, or what type of transactions consist or are included in investment and financing activity? These are transactions that relate to acquisition of non-current assets. So what are non-current assets? These are assets that you can hold for more than 12 months. You get economic benefits from them for more than a year. And examples are your fixed assets. So your fixed assets could be your factory, could be your machinery, things like that. Those are your fixed assets, because you can earn return or economic benefits from the usage of that asset for more than a year. And you use these assets to manage the activities within your company. So your machines, they help you through the production of your products. Your factory is where your process is being held. So you see that they try to help you manage and manage the activity that happens within your company. That's the investment side of this finance and investment cycle. So the financing part is that for this factory, for this machinery that I just mentioned, which is your investment asset, it has to be funded for, one way or another, because they cost a lot if you think about it. If you own a production line, all those assembly point, all those machinery that you're seeing there, they normally like worth millions. So you get what I mean. I might be exaggerating, but they are expensive. So your funding would be coming from your borrowings. Sometimes you use your overdraft as a company, or you use a loan, a long-term loan. You do finance leases whereby you pay for the interest and also you pay for the usage of that asset. And there's operating lease. So hence I'm saying that it's a bit close to FAC, which is financial accounting. So you should be familiar with the terms and what they entail. Okay, so that's the financing part of the cycle. And as I've always mentioned, it's very important that with the cycles that we have, you always start with the transactions that are within the cycles, like we just mentioned at the moment, of saying that the investment side is acquisition of your fixed assets, which are more than 12 months of enjoying the economic benefits. And the financing transactions are your borrowing costs, your finance leases, and your ops. Why is it important? Is because you need to know where do they fit in your books. When I mention books, I mean your financial performance. Where do you measure it? One, it's in the balance sheet, which is statement of financial position. And there it is, PPE, property, plant, and equipment. And then in your statement of comprehensive income, it will be in the profit or loss of that asset when you sell that machinery that you have, right? Otherwise, it's long-term loans. And then in your income statement, it will be your finance costs. Your investments, if you have investments, when you have surplus cash, you put into a deposit account, you will have profit and loss on that investment. So I hope you guys understand the two, to say that understand the transactions that are within the cycle, understand which part of the books what are the line items that they affect, and in which books are they in. Okay, I'm just going to be summarizing what like capital expenditure, just a bit in detail. And then this is where we will engage on activity 1 and 2. So we start talking. Capital expenditure, this is from your textbooks. It says that this cycle deals with transactions which a company enters into to raise finance. For example, you borrow money from a bank or investment company, as well as with the investment the company makes, whether it be in PPE or making long-term loans. That's what I just mentioned, that a capital expenditure has to do with expenditure means expense. And it has to do with the cost that you incur for having these investments that you have. So the type of cost, if you go back to your income statement, is that interest paid or dividends paid, but probably the interest paid for you raising those funds, even dividends paid. Because if you think about it, when you raise funds, you either go to a bank, you ask for a loan, that loan will have monthly payments, which includes an interest. That's your expenditure. Sometimes people raise finance through equity, meaning shares. You find that they issue out in the public to say that you can buy a share of a company for 5 Rand per share. Once people buy those shares, I'm making a simple example. When people buy those shares, you find that they're expecting dividends to be paid. That's also an expenditure, capital expenditure, because you raise those funds so that you can be able to buy your PPE and your investment. So that's capital expenditure. And what's important is that you understand that capital expenditure, this amount, because you're dealing with big money, as I've said, it's things that are long term, could be 20 years, it's more than a year. So that long term period requires you to ensure that before the decision is made, guys, there's planning that goes around it to say that they don't just wake up and say, we need X and X machine. No, they plan ahead to say that, is there a need for, let's say, this machine? And then there must be justifications within that. And then thereafter, someone within that range of approval, I mean that you find that 0 to 5,000, so and so can approve, between 50,000 to 150,000, so and so can approve. They need that authorization to say that, given what you guys have planned, I authorize and I'm happy with the justification for what you guys are doing. And once authorization has been done, that's when people are able to buy and acquire those PPEs. Then there's the implementation part, and then review and approval. So make sure that you think of those controls within the cycle, because I'm trying to make sure that you understand and make sense of what will be expected within the cycle. We don't just wake up and make a long-term fixed agreement, because it's going to impact you in the long run. Okay, so let's go to activity 1 and 2. Okay, then your study guide on page 113. This is where we talk. You guys talk. Give me what you think. It doesn't have to be a textbook answer, because this is a free zone where it's easier that you bounce off your ideas and speak louder, help you be able to not forget. You also learn while you talk rather than keeping it within. All right, so what do you understand by the term non-routine transactions? What does it mean? Non-routine transactions. What comes to your mind? What do you understand by that term?
For me, okay. Routine transactions is the one that it's your monthly expenses and so forth. It's something that you've budgeted for and what you expect throughout the year or the month. But a routine is, if I can use the example from what happened at my work. We had to buy a franking machine, and it was, let's say it was a 200,000 amount. We had to get board authorization to actually buy the machine, and we had to explain why we had to buy the machine. We had to jump through hoops to actually get the transaction authorized so that we can buy the asset.
Yes, I agree. Thanks for your response.
To support what she said, basically it's transactions that don't occur on a daily basis. Yes.
Doesn't happen on a day-to-day. Hence, I'm saying that with capital expenditure, you can't just say, hey, today we're gonna order this machine, which is 500,000. Tomorrow I'm like, okay, we need another forklifter, which is 250,000. All right, on Thursday I need, that's on a monthly basis. We keep on ordering forklifts. If you get what I mean.
Yeah, it's the same thing with when a company issues shares. It's not something they will just decide on, as you just said. They give a certain period in the financial year that this is when they'll issue out shares. It's not like a weekly, daily thing.
Yes, perfect example also. It's not something that just happens often. There is a reason behind every single company that issues out shares. They would know their internal reasons, because they know the cost that comes with those amounts that they received from selling their shares. Okay. So the feedback that we get is that non-routine transactions such as fixed asset acquisition do not usually occur every day. and the number and frequency of these transactions are considerably less than, for example, your sales, your purchases, and your salaries. The size of the transaction is usually significant, and these transactions are frequently subject to legal and regulatory requirements. So, with that being said, how do internal controls over non-routine differ from internal controls of routine transactions? How do the controls differ if you try to think about it? For example, how would a control over a fixed asset acquisition differ from a revenue recording or whatever, but revenue cycle control? Just brainstorm with me if you don't mind. What do you think could be the difference or something that you need to consider when it comes to your controls?
The normal transaction for purchasing, you have to create a purchase order, etc. like that. So is that? And then with a fixed asset, we'll have to go to a different process.
Yes, for example, I agree with the first part about the POs, but then with the fixed asset, what could you say that it's a bit different? Nasim?
Maybe if you like purchasing what should it, a baki or something, then you'll have to like maybe acquire quotations or something like that, and then get it authorized, something like that. I don't know.
Which might take a while, as opposed to when the PO, it's normally internal. Yes, there's requisitions and but then the process seems a bit lengthier when it comes to a capital expenditure or a non-routine transaction over the one that's routine. So let's look at the feedback. They say that because of the characteristics mentioned in one, transactions in this cycle are not subject to routine everyday controls related to the transactions. Internal controls over non-routine, such as finance, are still based on the 5 components of the control, but compensating controls will be implemented. So they're saying that you still need to think of your, let me say, for example, stationary versus a baki, like Nasim said. You'll still need to have order requisition to say that we need stationery in the office, same as with a baki, right? To say that we need a baki for delivery or for whatever. That could be the reason. Somebody has to review, someone has to sign somewhere on that requisition before the order is uploaded. The software is involved. So what I'm trying to say is that the normal controls will still apply for a baki. However, you still need to think of these compensating controls that I was talking about. That was it planned? Was it authorized? Was it implemented? Was it reviewed and approved? All right, so let's go to question 2. So Marika, we're almost there, but you are excused. Activity 2. It says that this is where we need to now talk, because there's weaknesses involved. Okay. I'll need your participation. Thank you. You have recently been appointed as the internal auditor of North Shore Pty Limited, a large shipping company in the PE. Your first assignment was, so what is your role? You've been appointed as an internal auditor. Done. Your first assignment was to evaluate the company's account system and related controls. The company is divided into 5 sections, each of which has its own section accountant who is responsible for producing monthly accounts and ensuring that sectional financial matters run smoothly. Okay, so the company is divided into 5 sections. Each of these sections have its own accountant who's responsible to make sure that the monthly process runs smoothly. While reviewing the financial records of the warehouse section, you were surprised to see the considerable capital expenditure that has been incurred just before the financial year end. So it's something that you just noticed. Out of all those 5 sections, you went to the warehouse section, and when you looked at the financial records, that's when you notified that there was a significant large amount that's been spent on capital expenditure for the year end 30 June. You found that the same expenditure has been incurred in all other 4 sections of the company, and on visiting the various sections in July, you noticed a fair amount of equipment still in boxes and not in use. Very strange, I must say. Deciding to follow this up, you approached Andy Bell, the most senior sectional accountant, and asked for an explanation of how the system for capital expenditure operated. So after you've noticed this from your previous visit at the warehouse and recognizing that this thing actually happens in all other sections, and by July, when you arrived, you could see that, these things are actually inside boxes. So you start asking questions to Andy Bell to say, hey man, please explain to me, how does your capital expenditure system work? And this is the response that he gave you. Before we look at the response that he gave you, because it's 6 of them, the required, it says that you must identify, meaning state number 1, what you've noticed, and describe. And remember, I said describe it, identify, and explain. So you need to identify and explain the weaknesses in the system of investment in equipment, sorry. And after identifying that, you need to recommend improvements to address that weakness. So when I state the responses from Andy, please try to identify what weaknesses are we dealing with and why are you saying that it's a weakness. And number 3, lastly, is what do you recommend? What could be the solution to the weakness that you've identified? Altogether, I hope. So number 1, it says that each sectional accountant is responsible for capital expenditure of his or her section. And so I'll read 3 and then read the 3 later. So each sectional accountant is responsible for expenditure for his or her section. And then a budget is prepared in the office of the financial director. Budgeting figures are calculated by increasing the previous year's budget by the CPI. CPI is inflation. Sectional accountants are noticed as to what their section can spend on the purchase of capital items. However, if sections do not spend their capital budget in any of the financial year, that sectional budget is reduced for the following year. As you can see, we all try to avoid a cut in our budget by making sure we spend our budget before the end of the year. So from the 3 things that I've mentioned hereby, number 1, each sectional accountant responsible for their section. Number 2, budget is being performed at the FD. And budget is being increased by CPI. All right. And number 3, you need to make sure that you use up all your budget, because if you don't, next year it will be reduced. So my question to you is, from what I've read, what weakness do you identify, and explain what gave you that trigger to say that this is a weakness, and give me a recommendation as to what can they do better to ensure that that weakness is at an acceptable level. That's my question to you guys.
With number 3, when they are given a budget, they have to use their budgets, or else the following year they'll receive a lesser budget. Because in a company, to maximize profits, you have to have less expenses. So if we're giving a certain department a certain amount and tell them that they have to use all of it, they will even use it on unnecessary things. So next year they won't have a smaller budget. So they'll have unnecessary expenses. As a recommendation, they could evaluate where they actually need to spend the money and use a minimum amount. And this shouldn't influence their budget for the following year.
Okay, cool. I hear you, and I fully agree and understand what you just mentioned of regarding number 3, to say that, hey, these people, when they are busy, I guess what gave you off to what you're saying is the fact that by the end of the year, they need to ensure that they finish that budget so that next year their budget keeps on increasing as opposed to decreasing. And your recommendation was that they should have a certain range to say that this is how much you could spend, so they don't get to a point where now they just buy for the sake of buying because of there's a budget.
Yes.
Yeah. And what are the others saying? What are some of the weaknesses that you've identified from the three statements that I just mentioned?
I think if they had a proper planning when they budget for stuff throughout the year, they wouldn't have had to buy stuff to use the budget. But if they had a proper budget before the starting of the financial year that was authorized by top level, and they had to buy exactly what was planned for, they could have not be in that position of buying stuff that was not needed just to spend the money.
Okay, so you still within the same weakness that Nokolo identified. You're just saying that, but what are some of the assumptions that you think that they must have within the planning? Because planning does happen, it's just that they adjust their number by CPI. So when you say proper planning, what do you mean by that?
A proper planning of what they want to purchase. For example, I plan to buy vehicles every 3rd year and to buy office furniture every 2nd year. To stay within that plan, stuff wouldn't have been in boxes that wasn't needed to purchase. So I think it's just the proper planning within a budget.
Okay, cool. Thank you so much, Madeleine. What are others saying?
If too much accountants, like if each department, say if you have now an organization with five different departments, then you can have too much capital expenditure rising.
Okay. So what would you recommend that they do?
Like maybe have allocate one department, not having each sectional accountant. Like maybe have one accountant responsible just for the asset thing.
Okay. All right.
To add on with number one, when they say each sectional accountant is responsible for their capital expenditure, it means that no one oversees what they buy. No one actually approves what they buy.
That's a weakness. And what would be your recommendation?
Is that as much as there are these 5 departments, because it states that it is a big company, before they buy whatever, they have to get approval maybe from the financial director or the board or something.
Okay, so there should be an approval and authorization. Let's look at one of the answers. So one of the answers that they've identified is that, remember I told you guys that when it comes to identifying your weakness, normally it's one sentence and then you give your reasons. Okay, so number one was that the weakness that they identified is the acquisition is not planned. So the beginning, there's nothing that drives what they order. So there's no planning. And there is no evaluation of whether the items purchased by the 5 sectional accountants are required. Like, as I've mentioned, fixed assets or this, it's not a daily thing. It's not a routine transaction. As a result, a person needs to understand or have a necessity table to say that it was necessary for them to show that as any member, and then the recommendation was that the company should appoint a fixed asset committee consisting of senior management, which will take responsibility of evaluating the need of purchase and the expenditure. Number two is that any member of the section can request treatment without providing proper motivation. All requests for fixed assets should be fully motivated. Okay, number two, the budgeting process is totally ineffective simply by just adjusting your prior year with your CPI. That is just not effective. And as a result, a proper budgeting system should be in place. Each section should carefully evaluate their actuals for the upcoming year. Do you guys see, while I'm still reading from this, but from my report, can you guys see that even when you say that you need a proper budgeting or proper planning needs to be in place, you need to substantiate your answer. You need to say that what does it mean? How does a proper planning or a proper budgeting look like for you? Because even with them, as I was saying, they see themselves doing well by just adjusting their previous financial year with the budget. And adjusting it with the CPI. So in your answering, ensure that you identify a weakness is a lack of inadequacy, ineffectiveness. So I'm trying to teach you the words that goes along with the weakness. So lack of inadequacy, ineffective, inefficient, lack of. So when you are provided with a question to say, give me the weaknesses, identify them, that's how you identify. It's only on the part where they say describe that you will start giving us reasons as to what is it that triggered in your mind to say that I have a certain concern around these systems. I hope you guys get what I mean by saying that how you answer will determine the amount of marks that you have, because you'll be able to substantiate to a point where the person marking your script will understand what you say. Because I still say you cannot assume that the marker understands auditing. You need to write as if the marker doesn't understand auditing. And for you to get to that level, you need to ensure that when you say certain terms or certain things, you elaborate further. Not to say write paragraphs and paragraphs, but learn to shorten your answer and learn how to ensure that you hit the nail, you are clear and precise in your answering. Cool. Number 4, if a staff member in the section requires equipment, for example, in my emails, my assistant with the precise details of what is required, as well as the name of the supplier. Let me repeat that. If a staff member in the section requires equipment, for example, in my warehouse section, the foreman may decide that he needs a forklift. He will email my assistant with the precise details of what is required, as well as name of the supplier. None of the equipment used by North Shore is particularly complicated, so this method was fine. What weakness and recommendation do you see and have here?
Because there is
Sorry, before you continue, you're saying it's a lack of
control or a lack of ordering the equipment, because they don't order the equipment by means of a prescribed form that can be evaluated and ticked off and filed. They just do a requirement via email.
Okay, all right. And what would be your recommendation?
I would recommend that there must be a specific order form and prescribed form to be completed and go through a whole process where to acquire a forklift needs to be approved by higher authority and maybe directors to approve the procurement of a forklift.
Agreed. Okay. And others?
Can I add?
Yes, Naeem.
I would say that I would agree with what Madeline says, and I would add to it the order form should have at least 3 signatures.
And who are those people's signatures, Naeem?
You can have top management, at least three top management approving the order form, something like that.
Yes, I agree. And as I mentioned, Naeem, when you say 3 signatures, be specific. Top management, then you're done. Those 3 signatures could be anyone. Okay? Thank you for your answers, guys. Number 4, the controls over the requisitioning and the ordering and receipt are inadequate. You've identified the weakness, and your reason for saying that would be no properly designed pre-printed sequence requisition form is presented to support the purchase request. Remember, I've also mentioned that ensure that you apply the information that you've been given in the question paper. So when you speak of an email, we already know that in this scenario that we're looking at, they did speak about currently this is what they do, they send via email, but they don't talk about the supporting document, which is the requisition form. Okay, so recommendation is that they must have a designed 2-part printed capital requisition and must be prepared and signed by a senior person, for example, the warehouse for the forklift. Okay. The others you guys will look at. Question 5. It says that my assistant then completes and pre-printed, numerically sequenced, and multi-copied order form, which the sectional accountant signs before sending the top copy to the supplier. The second copy of the order is sent to the Central Creditors Department for payment and used by the assistant to write up the equipment, to the section by the assistant. So it's quite a mouthful, but what it's basically saying is that then the assistant pre-printed the top copy to the supplier. The second copy is then sent to the creditor statement. The third copy is left in the order book and used by the assistant to write up the copy that is left in the order book. So what weakness do you identify here?
I think since it's the assistant that makes the order and is the assistant who receives the equipment, there has to be a segregation of duties.
Okay, so what is the weakness that you identified? Because you gave me the recommendation, but not the weakness. So what is the weakness?
The weakness for 5 and 6 is that it's the same person who completes, who makes the order and receives it.
I just want you to formalize your answer to say the weakness is the lack of, or what is, because what is missing? No. I know. I'm pushing you guys to get answering questions. Or Madeleine, anyone? From what Notolo said, she said that it's the same person who does all of this. So that's an indicator and that's a reason. And she gave us the recommendation to say that there should be segregation of duty. So I'm saying that what's number one that you need to score? What is that weakness?
The weakness will be there's a lack of segregation of duties.
And you must say over what?
Because there's not different people doing different, one places the order, the other one receives the goods, and a third one writes up the records. This is one person that does everything, and this forklift could have been delivered to her house instead of the company itself.
Yes. And you see what I was trying to push you guys to. This is what I was saying, that the weakness, you must say it, like what is the weakness? So they say there is a serious lack of division of duties. In respect of who, you must be able to pinpoint to say that there is a lack of segregation of duties over the assistant to the sectional accountant. Like, be specific where that segregation of duty is. I'm hoping that you guys understand what I'm saying, that ensure that you state what the concern or what the weakness is, what's bothering you, and then you give us the reasons as to why. So as you both ladies said, the person who places the order, who receives the goods, is the same person, you know. And what should happen is that once they receive the item, a responsible official should be there to check delivery against requisition before signing. And once the above is completed, that's when the assistant will come and write up the fixed asset register. So this is a good example to say that even with capital expenditure controls, that there might be a bit different in terms of frequency with the normal transactions that we are used to. That capital expenditure still follows the controls that we would normally have under a routine transaction. All right, this is where, because this is the same even under acquisition, it's the same even under revenue cycle. But then under investment cycle, it still applies. It's just that over and above that, there's still those component controls that we looked at. So I'm hoping that you guys are starting to see how you must answer and earn full marks in auditing. You need to answer the required. Don't start with your comfort zone, which normally when it comes to a weakness question, you guys will start with the reason, but you didn't give us, and your reason normally is an indicator. I mean, not an indicator, but you're giving us reasons, and they might go long. That's what I'm saying, that sometimes you might get into the habit of talking a lot in your papers, and that is an indication that you are brainstorming. So try to summarize and answer the question. Ask yourself, have I answered the question? Did I identify, number one, did I identify my weakness? Number two, they told me that I must describe. So me, I must identify and explain. So did I give them my reasons? Number three, recommendations. Are my recommendations aligned with what I identified as a weakness? Be able to use documents that a person needs to look at, and who's that person who needs to check what against what. So I really need you guys to get to that point, because that's when you'll be able to earn a full mark. All right, so let's look at one of the questions under one of the old assignments that were done. And it's a 3-marker. Okay. So let's read on finance and investment cycle, and we'll be done with finance. It took us an hour. We'll be done with it, and then we'll look at other cycles questions. Okay. I hope you're up for it, and it will be almost similar questions that we are going through now, where I will be assisting you guys to know how to answer. So please bear with me with the questions that I ask you, because I would be pressing you to hit the nail when it comes to answering your questions. Cool. Finance and investment cycle. Mr. Molaudi is considering an investment in a company that specializes in the distribution of bottled water in Africa. Their head office is located in Lagos, Nigeria. He is ready to sign the contract without visiting the head office and without having a valuation specialist, as Mr. Molaudi is eager to take advantage of this opportunity very quickly. This will result in a large increase in Taulo's investment for the coming financial year from him buying that head office. What is he buying again? Yeah, the
Bottled water.
Bottled water.
yeah, but what is he buying? Specializes their head office in Lagos. He was ready to sign the contract without visiting the head office and without the valuation. Okay, cool. So it's the company. He's buying the company of the bottled water. Thank you, guys. This will result in a large increase in Taulo's investment for the coming financial year. In order to finance the investment, Mr. Mlaudi plans to make use of a bank loan. So they tell you what the investment is, which is the company, the Berkeley Water in Nigeria, and that he was willing to sign without even going to see the head office, without even consulting the valuation specialist to tell him how much is this company actually worth. He based it on the fact that he was eager to make this decision, to take advantage of it, and the fact that the owner appears to be an honest individual, given the fact that his financial statements were growing. So now, over and above that, he decided that he will take a bank loan to buy. So what is the question? Let's go down. With a reference to the information under the heading Finance and Investment Cycle, describe two major risks related to the possible increase in Taulo's investment. What could go wrong with this investment, given what you know about finance and investment cycle?
A lot can go wrong, hey. I think firstly for the fact that he hasn't visited the actual place, and he hasn't consulted someone who will tell him how much is the company worth. It could happen that the company doesn't exist.
And what will it do to this whole thing? Because remember, at the end of the day, it's going to affect his investment. It's going to increase his investment on his balance sheet. So what I'm trying to say is that you said that what could go wrong is that this company might not exist. Okay, but then, so what? What would it impact on his financials or what? So what I'm trying to say is that having the investment to be non-existent, what would it mean for Mr. Mlaudi and his company? What would affect him the most due to what you've identified?
It would affect his finances because he won't have any returns, and he will actually have a loan, more liabilities to cover with no income coming, with no returns.
Yes, cool. So I like that. So you're saying that it will affect him in an instance that now you will have a loan, a long-term fixed commitment over something that's not existing. So result will be paying for nothing, which affects his liquidity if you think about it, because he could use that cash for something else. I mean, even his debt, it will limit his debt capacity, right? Can't take more than, because you always have a limit. Okay, comfortable, thank you. What other risk is there, guys, from what we've just read? This is 3 marks, so probably it's 1.5 mark. Probably 1 would be identify the risk and then you explain. Because they said describe. So you have to identify the risk and then tell us why you think that's the risk. So what's number 2? Let's think. What could be number 2?
I don't know whether it falls under the same thing, like to buy to the supplier that you don't know of. That is a risk. You need to check. It's like number 1.
Yes.
Yeah, I think it's number 1. It's covered in point 1, what I was going to say.
Yeah. Okay.
A risk can be that the financial statements does not reflect the true situation of the company that he wants to buy. That financials can be misleading.
Okay, yes. And what would have caused that?
Where they state that in the financials, it's a company with a lot of profit and they do a lot of business with stuff, but it's actually not the case. They hide information in the financials to look good for somebody to buy into the business, but the actual fact is it's not a true reflection of the business.
I like that one. Okay, I like that one. You are correct. So your indicator is that the risk is that the bottled water company might be overstated, right?
Yes. Yes.
And as a result of that, it will affect Taulo's financial performance, because back to number one, it might be that it's not the case. And as a result, that means that Taulo's investment balance might also be overstated and therefore leading to financial statements that are misleading.
Yes.
Yeah. Thank you, Madeline. So next time you answer that way. Because I'm liking how you like, yes.
I'm learning.
Yes. But I'm like, yeah, so next time you need to. So what I'm saying is that you guys are giving beautiful answers. Yes, it's good to brainstorm and say it. But then thereafter, you're like, okay, so what is it that I'm saying?
Okay.
You know, how I also took a step back. Take a step back to say, what is it that I'm saying? Am I identifying the risk? And am I explaining the risk?
Yes.
Okay, so let's look at the answers. Remember, the answers don't have to be similar to us, but at least we should see if we are on the right track. So they say that Taulo may understate the long-term liability, which is the bank loan, which is a risk. They may overstate the existence of the investment, as Mr. Molaudi did not confirm the existence of the company in Nigeria. Taulo may overstate the valuation of the investment, as they did not perform proper due diligence of the investment, which is things that we've mentioned. So happiness with that. And that is the end of the finance and investment. So I was suggesting that we have our auditing class on the 22nd around 7 p.m. Is that fine?
Yes.
Yeah.
Okay, auditing at 7 p.m. on the 22nd. And remember, there's no class next week. And what we'll be doing is the corporate governance question. I will state it's question one, because corporate governance is at the beginning. So it will be literally this first question of corporate governance. And it will be the first questions on corporate governance. So please go back to your table to know who's who, under which committee, how many, all those. So revise so that we can do the questions properly. So we'll be doing corporate governance on the 22nd.